silver, I think, is the ultimate opportunity for those that are struggling to try and find a way to protect themselves right now when gold or an ounce of gold feels too expensive. Look, it's up more than 60% this year. We're not at the 1980 or 2011 gold silver ratios of 15 and 32, but there is a clear indication that there's a massive supply deficit in this metal. I mean, you've got open pit restrictions in Mexico, et cetera. But what
Yes.
the market cap for silver is like literally it's half of Nvidia, for God's sakes. I think it's a $2 trillion market cap. So there is any even measurable increase in demand for silver will send its price up significantly. And it's certainly, you've got guys like David Bateman buying a lot of silver right now. I don't think it's because they're just speculating. They see an opportunity for massive 5x, 6x, 10x price appreciation, but it's a way to protect themselves in a precious metal that's affordable.
Matthew Pipenburg says the next financial crisis won't look like the last one, because this time, money won't run back into the US dollar. The so-called safe haven has shifted. Institutional investors, not retail traders, are quietly moving toward gold, treating it as the only asset that truly holds value when confidence in fiat starts to crack. He believes that in the next major sell-off, gold won't collapse like it has in past panics, it'll rise sharply. The flow of capital will move toward tangible assets, not paper promises. Pipenburg says this changing mindset also shines a light on silver's role. People like to call it the poor man's gold, but he calls it the smart man's silver. It's still affordable, still overlooked, and still sitting in a deep structural supply deficit. Industrial demand is rising fast, especially from green technologies and electronics, while new supply struggles to keep up. Despite being heavily shorted on major exchanges, silver continues to grind higher, pushing toward record levels. He adds that silver's total market size is minuscule compared to trillion-dollar tech giants like Nvidia. That's what makes it so explosive. Even a modest flow of institutional capital into silver could send prices soaring. Investors like David Bateman aren't chasing quick profits, they're positioning for what comes after fiat. Pipenburg says both metals tell the same story. When the next confidence shock hits, the winners won't be those holding cash or credit, but those holding something real. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
And look, I've had really compelling conversations a few years ago with Brent Johnson online, good discussion on the DXY, recently in South Africa with Henrik Zeeberg, who like Brent Johnson, sees a spiking DXY, kind of what he calls a last dance. And of course, Brent Johnson has a very intelligent milkshake theory, which has validity in a lot of ways. And I think, and recently Francis Hunt and I were double teaming poor Henrik Zeeberg on a different argument. But it's important to listen to what they're saying and not just take my word or Francis's word or other gold bugs' words, because there is a compelling case that the DXY, or the dollar on a relative basis to other currencies, is still the best horse in the glue factory. I totally understand that, and I respect it. And I know I'm going to oversimplify this and upset Henrik or certainly Brent Johnson. But their argument has some merit in the sense that, look, what they're basically saying, and as your other guest was saying, is on a relative basis, what are you going to do? The ruble, the yuan, the yen, the rupee? It's not going to be anything but the dollar. And they point out that 58% of global FX reserves are still in the U.S. dollar. 80% of global trade is financed in the U.S. dollar. There's 13 trillion in global U.S. dollar denominated debt. There's euro dollar demand, 10 trillion there. There's probably another 90 or 80 trillion in FX swaps that are traded in U.S. dollars. So that any massive deleveraging of the U.S. dollar or U.S. treasuries would actually send the dollar up. In other words, it's almost too big to fail. And what's interesting about these conversations with Brent and with Henrik is all of us, including the Bitcoin guys we talk about, we can disagree on the DXY, but ultimately we all agree that gold is the final end game. What Henrik is saying, unlike Brent Johnson, though, he says the last dance for the DXY will happen when there's another market sell-off. If this market ever does mean revert, like in 2008, there'll be a run to safety. There'll be a run to U.S. Treasuries, and there'll be a run to the U.S. dollar. And like in 2008, we could see a massive pullback in the gold price, like 30%, as we saw in 2008. So he's basically using 2008 as an example. And that's a valid point, but I think what's wrong with that is 2025 and the gold roll today is very, very different than 2008. The BIS has made gold a tier one asset. The IMF is talking about gold. It is not 2008. So when there is, or if there is an uh-oh moment in this otherwise immortal stock market, which is monetized by the Fed and money printing liquidity, if there is an uh-oh moment, it will not be like 2008. There won't be the US Treasury will not be the tier one safe haven lifeboat that it used to be in 2008. And the US dollar won't be. Again, for that whole string set of reasons we've just seen, the world doesn't trust the US 10-year. It doesn't trust the US dollar the way it did in 2008. So I don't see it the same way.
You were saying it'd be worse than '08, Matthew?
No, I'm saying the market crash could be worse, but the gold price
Right.
is not going to go down. It's going to go up because the money's not flowing to the
Right.
dollar. It's flowing to gold. It's already pre-flowing, preparing right now.
Yeah.
Even if there's a rally in the stock market, the safe haven the world is already turning to, not the retail investor, but the big investors. I certainly see it in Zurich. The safe haven today, just like the BIS has said, is now gold. I'm not saying that just as a gold bug sell my book, although I could be wrong, but the evidence suggests that the safe haven in 2025 won't be the US 10-year, it won't be the US dollar, it will be precious metals and other hard assets.
Well,
That's what I see. Of course, I mean, people always say silver's the poor man's gold. I think it's the smart man's silver. And I think it's probably the most undervalued hard asset and certainly the most undervalued precious metal. Platinum's another interesting case. Silver, to your question earlier about what do retail investors do or what can they do, I have to be very respectful that many listeners here don't have $37,000 or $4,000 to buy an ounce of gold, and they feel like they've missed out. And they're trying to get through the month with mortgages, rent, tuition, or whatever. How can they possibly protect themselves? How can they take advantage of this open destruction of fiat money and protect themselves if gold feels too out of their reach? And to your point, silver, I think, is the ultimate opportunity for those that are struggling to try and find a way to protect themselves right now when gold or an ounce of gold feels too expensive. Look, it's up more than 60% this year. We're not at the 1980 or 2011 gold silver ratios of 15 and 32, but there is a clear indication that there's a massive supply deficit in this metal. I mean, you've got open pit restrictions in Mexico, et cetera. But
yes.
the market cap for silver is like literally it's half of Nvidia, for God's sakes. I think it's a $2 trillion market cap. So there is any even measurable increase in demand for silver will send its price up significantly. And it's certainly, you've got guys like David Bateman buying a lot of silver right now. I don't think it's because they're just speculating. They see an opportunity for massive 5x, 6x, 10x price appreciation, but it's a way to protect themselves in a precious metal that's affordable. And I think the fact that you've seen so many shorts on the otherwise dying COMEX or the LBMA
Yeah.
exchange in London, and despite the shorts, silver's knocking at the door of all-time highs. And because of its limited supply and because of its small market cap, I see a massive opportunity for silver. Again, I think it's the most undervalued asset in dollar terms or even priced in gold terms right now. And again, we're seeing huge interest in silver at our desk in Switzerland. It's not by accident. It's not just by desperate speculators. It's by people who see a massive price appreciation, but a precious metal that's actually affordable, especially for the man on the street, which is incredibly important. But I think if you're looking at silver, remember, you've got to have a long-term view. It's not just a speculation asset. It's a monetary metal. You have to hold it with a sense of insurance for dying paper money. And just like gold, you don't want to just trade it for a 2x return. You've got to be patient, as Rick Wool said. Silver rewards infrequently but extravagantly, and silver's position right now for some fantastic return. I do. I think it's like, again, it's always the inverse of the dollar. And since the US is broke quantifiably on its balance sheet, as Hemingway described, poverty is happening slowly then all at once. It's going to be the same thing with the disintegration of the dollar, slowly then all at once. The gold price has been knocking from 1,600 to 2,200 to 2,500 to 2,800 to 35. It's slowly then all at once. It'll be particularly the case for silver, which is like that little speedboat next to the juggernaut that is gold. When gold is hitting all-time highs and when gold is in a bull market, silver tends to dramatically outpace in terms of its speed of movement. I don't think gold's even in its bull market yet. We're clearly at a turning point. But gold is just in the first or second chapter. And I think the reason silver hasn't fully caught up, other than the mechanizations on the COMEX, et cetera, which is disintegrating, one of the reasons silver hasn't really seen that compression of the gold-silver ratio is because really the gold bull market is just beginning. And as it gets more traction, as it becomes more obvious, then I think silver, in terms of just pure price appreciation, is going to be a massive move. And so I'm highly recommending silver as an allocation.
Matthew Pipenburg says the constant noise around gold often misses the bigger picture. It's not really about gold itself, but about fiat money and the way governments manage debt. Every major financial crisis in history traces back to the same root problem: too much borrowing, followed by currency debasement to make that debt manageable. He explains that this isn't new. From ancient Rome to modern America, the pattern repeats. When both good money and bad money circulate together, people instinctively save the good and spend the bad. Rome diluted its silver coins, Europe replaced gold with copper, and in recent centuries, countries like Weimar Germany, Zimbabwe, and Venezuela all printed their way into collapse. Each time, the outcome was the same. Hard assets like gold eventually restored confidence. Pipenburg says we're watching that cycle unfold again. The dollar is losing ground, central banks are buying gold at record levels, and more global trade is being settled in currencies other than the US dollar. Even major institutions like Goldman Sachs and Morgan Stanley, long champions of the financial system, now acknowledge gold's growing importance. For Pipenburg, the lesson is simple. When governments abuse fiat, history shows that gold always finds its way back to center stage. Let's get back to the interview.
Yeah, thanks, Daniel. I mean, there's so much, I don't want to say clickbait. There's a lot of drama. There's a lot of sensationalism in the gold space for years. There's this pawn shop asset kind of reputation. And certainly there's all of us in our book, talking our book, biased about gold. But I want to get away from just being an executive in Zurich talking gold, because it's really not about gold. It's about fiat money. It's about the dollar. It's about the history of fiat money. And it's really theft. And it's not mistaken theft or stupid theft. It's deliberate policy theft when countries are in debt up to their ears and no longer have good options. And they take from the people, and that's not a desperate act. It's really a cyclical act. And to put that into perspective, again, it just needs get away from boring themes and boring economists and just stick to some real historical moments. And then that helps build, I think, a case of placing the headlines into context without getting bogged down in a lot of gross history. But I wrote a book in 2019 called Rigged to Fail. And it's a game, really, Wall Street, and what I've seen in it, what I've studied, what I practiced in it. And unless you are prepared for this rigged to fail game, unless you're informed, you're going to be on the losing side, because the policymakers are not your friends. And that sounds sensational and maybe clickbaity, but it really is the debasement and devaluation of currency to monetize debt. That's open theft, but it's frog-boiled, it's very slow, but it repeats itself over and over. When policymakers are at that Waterloo or Stalingrad moment where there's nothing left to do but debase the currency to monetize their debt, and they can continue this game slowly and frog boil it eventually, but eventually we feel it. And eventually the man on the street loses, because Wall Street, as a metaphor, is very, very different set of values than Main Street. And there's a lot of dishonesty and cyclical natures of this. And what I see, and I'll try to do this really quick so we can pull on all the other strings. But I see in historical patterns, from honest economists that go back to the 1500s to the 1970s to today,
Yeah.
these patterns, and then current headlines, objective facts that are really confirming what is fatal math for the US dollar. Because what we're seeing is a credit cycle ending, which is really a dollar cycle ending. And as that debt credit balloon approaches a popping moment, that doesn't mean a stock market popping moment, it means a credit debt moment. And when that pops, the currency used to monetize that debt is always debased and devalued, and it melts like an ice cube. And governments, through their deliberately debased fiat money, are really insulting their citizens in a very slow and deliberate but intentionally complex frog boil. So again, policymakers are not your friend. And the way to put this into some historical context, and I'll stop in 3 minutes and we'll pull on any string you want. But look, from the 1750s, from David Hume, we know one thing: debt always destroys currencies. And there was Sir Thomas Gresham from Gresham's Law in the 1500s in England, who said that trusted money, when it circulates at the same time as debased currency, Eventually people will spend the bad and hoard the good. They'll figure out that the fiat money is bad and that hard assets like gold are good. And eventually they'll replace the bad altogether. And that's what this other economist from the 18th century, a French guy named Adolphe Thiers, said. In a crisis, real money drives out the bad currency. And again, we saw this with Rome and ancient Rome with the denarius. It was all silver. And over a period of 200 years, they chipped away all the silver. It had no silver. We saw this in medieval Europe when gold was replaced with copper. Clearly, the more modern examples like Weimar in the 1920s, when prices were doubling every week, no one wanted to hold marks. They were like hot potatoes. So they fled to other currencies at the time, like the dollar or even cigarettes or barter or gold. And then there are classic examples in Zimbabwe or Venezuela. But these are all patterns that we can see. We could spend hours on each of these kind of historical moments. But the current headlines really are showing that just as Thomas Gresham and Adolphe Thiers had warned, that the debasement of paper money leads to the preference for real money, that is gold, over fiat toilet paper, even if that paper is the world reserve currency. And this explains so many of the open signals, of which, again, each of these signals deserves their own episode, their own hour, but they're all around us right now, and they're not just coming from the gold bug camp. And I think if we put this in the perspective of how fiat money is debased to monetize drunken driving debt, we see this, and I'll just, the list is long and distinguished. We certainly see it with the BRICS rise and the open de-dollarization process that we've talked about ad nauseum, and the process away from the greenback and the U.S. Treasury, which is no longer a slow drip trend, but really a rapidly expanding direction. We see it with the DXY, which has gone from 115 to 98. We see it with central banks since 2014, had been net stacking gold and net dumping U.S. Treasuries as a reason. We see it in the 20% of global oil sales that are no longer in the petrodollar, that are occurring outside the U.S. dollar. We see it in the open panic and disintegration of the COMEX and London exchanges, who are seeing net outflows of physical gold because the counterparties want their gold more than anything else. We see it with the BIS, which has made gold a tier 1 asset. We see it with the IMF back in during the COVID hysteria, which saw gold as a pure gold as a fundamental to its otherwise impure CBDC initiatives, which are slow boiling out. We see it in the 3 consecutive years of central bank gold stacking at record levels, over 1,000 tons per year since the USA weaponized the dollar back in 2022. We now know that central banks hold more gold than U.S. Treasuries on their balance sheet. That's the first time since 1996. And even Morgan Stanley, which is no true friend of gold and frankly not an honest fiduciary to its clients for decades, is suddenly saying there should be a 20% gold allocation. Goldman Sachs is saying there should be a 7% allocation. So the whales who are against sound money can't deny their clients want physical gold. We see it with Judy Shelton talking about introducing a gold-backed U.S. Treasury. We see it with Trump's tariff policy to try and monetize the debt. And certainly we see it with the desperation of the Genius Act to create stablecoin demand for otherwise unloved U.S. Treasuries and U.S. dollars. So just as Thomas Gresham in the 1500s and Thiers warned in the 1700s, centuries ago, the world is hoarding gold and turning away from bad money. And just as history warned, the U.S. dollar is being openly devalued to pay down a debt crisis of their own making. And I'll close because this is nothing new. In fact, it's recent history. In 1993 or 1933, FDR, by executive order, confiscated gold overnight. It was at $20 an ounce. The next day it was at $35 an ounce, revalued. But when he did that, he devalued the dollar by 69% in order to make Uncle Sam's debt burden 69% less onerous. And of course, Nixon in 1971 totally welched on the US dollar and its gold backing and the world by removing the gold backing of the dollar. And since then, the dollar has lost quantifiably over 90% of its purchasing power. So this certainly made Uncle Sam's appalling bar tab easier to repay, but only by gut punching those who measure their wealth or their savings or even their portfolio returns and even their retirement in the US dollars. So again, this is a deliberate policy of debasing the money that most folks measure their wealth by, certainly the US dollar, but any fiat currency. It's debasing the dollar or debasing fiat money. This is nothing new throughout history. And the loser is always the trusting citizen who believes that their fiduciaries, their elected officials, their policymakers with the PhDs and the Harvard degrees and the blue suits, but they're no different than a thief with a mask and a burlap bag telling you to put your hands in the air because they're slowly robbing you of your purchasing power. That is why gold is at all-time highs almost every week, and that's why it's hit the 4 handle today, and that's why it's going to continue to rise. That is not an executive trying to sell his book. I want people to understand this is actually nothing new throughout history.
What's unfolding across global markets feels less like a temporary cycle and more like the start of a monetary reckoning. The faith that once anchored the dollar is quietly eroding, replaced by a return to tangible value. This isn't about nostalgia for gold coins or silver bars. It's about trust. Investors are beginning to recognize that paper wealth depends entirely on policy decisions, and those policies are stretched to the breaking point. The last decade of cheap money built an illusion of stability. Now the bill for that illusion is coming due. Gold and silver are stepping back into the role they've played for centuries, not as speculative bets, but as the final line of defense when confidence in the system fades. If confidence continues to drain from the financial system and capital turns toward tangible stores of value, will this shift mark a quiet reset of global wealth or the visible end of an era built on paper promises? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.